If you have been working with your accountant, auditor, or tax agent, then most likely you have heard some of the common accounting jargon or accounting terminology such as AR, AP, GL, and JB. If you don't understand this accounting jargon, don't worry. Let me be your translator today. I'll translate the accounting jargon into simple English for you in this ultimate guide to accounting jargon for business owners. If we are just meeting, I'm Sharon Tay from Nuts Accounting, and I'm a certified advisor for Zero Accounting and QuickBooks Online. And if you only do bookkeeping once a year, or maybe you would like to learn what are the benefits of bookkeeping to your business, then stay until the end where I have a bonus tip for you. So today, let's get started with the accounting jargon that we are going to cover today. Let me pull up the slide. All right. So the first accounting jargon that we are going to talk today is trade. If you have been hearing the term of trade, like from your auditor or your tax agent that keep asking you questions like, what is this transaction for? Is this transaction a trade transaction or is this not a trade transaction? So what do they actually mean when they mention the word trade? So trade actually means your usual business activity, which is the sales and purchases of your products or services. For example, if you have an online business, For example, if you have an online business where you sell online courses, membership accesses, and consultation sessions, then this will be considered as your usual business activity, which is also known in accounting jargon as trade. But if, for example, you sell your used laptop, which is your fixed asset, and you no longer use it, and you would like to sell it to generate some cash for your business, then this is not your usual business activity, and it is not considered as a trade activity. So if you have an e-commerce business, selling your products on Etsy will be considered as your usual business activity, while selling your used sewing machine, which is also your fixed asset, is not your usual business activity. So the term trade is commonly used in trade receivables and trade payables. So we are going to cover the next term. The second accounting jargon that you commonly heard is AR, which is also known as trade receivables, accounts receivables, or receivables in general. So accounts receivables is also known as trade receivables, receivables, or AR. AR, which actually stands for A for accounts and R for receivable. So accounts receivables are usually related to the money that you will receive from your customers for the sales of your products or services. So for example, if you sell to your customer and then your customer will pay you money, so that anticipation of the money flowing into your business is called receivables. You are pending to receive the money. So that's why whenever you heard the word of receivables, always remember where the money flows. Where the money comes in, where your business is pending to receive the money, then that is your receivables. So here's the easy way to remember it is always follow the flow of the money. So that's why it's called receivables for all the customers related transactions. But actually, there's a catch to this. If you only remember the flow of the money, but then there's a certain caveat to this. So the only money from the sales of your products or services will be considered as accounts receivables, which means only the customers that owe you money will be considered as accounts receivable. So if for other kind of situation where the money flows into your business, like for example, you invest money into your business, or maybe you receive a loan from a bank, then those are not considered as receivables. So always remember receivables, when you try to track it according to the flow of the money, is always related to your trade products or your trade services. Okay, the next one. Oh yeah, I want to talk to you about our Master User Academy Level 1 mini course. So I believe that if you are interested to do bookkeeping for your business, I think you will be interested in our Master User Academy Level 1 mini course. And by the way, this course is completely free. If you are new to bookkeeping, confused about where to start, not sure what to do with your receipts and invoices, or you're just frustrated that bookkeeping takes up a lot of your time, then this free mini course is tailor-made for you. Our step-by-step guidance will kickstart your bookkeeping journey and boost your confidence and skills to efficiently complete your monthly and annual accounts so that you can use the financial reports to grow your business faster. This mini course is absolutely free for you, so sign up today at nutscounting.com/400. And now let's continue with the next accounting jargon, which is AP. So what is AP? AP stands for Accounts Payable, and actually this is pretty similar to the one that we have mentioned just now, AR, where the A stands for accounts and P stands for payable. So accounts payable, trade payables, or simply known as payables. So AP is actually the opposite of AR, where AR is more towards the sales related portion of it, where you receive money, while on this side, on the other hand, is more towards the money that you pay out. That is why it's called payable, that you are pending to pay it out. So this AP is more related towards dealings with your trade suppliers, where you purchase some of the, like for example, if you are selling goods or products. So if you buy products from your supplier and then you resell it to your customer. So the supplier that provides you with the products, which is also the trade, which we call it as the trade product. So this supplier's transaction will be considered as AP or payables, accounts payables or trade payables, which we also call it like that. And when you sell it to your customer, then that would becomes the AR part. So AP is more towards purchasing side, where you purchase something to sell it out. Or maybe if you are not dealing with goods or if you are not selling goods or products, then it could be your service providers. For example, if you sell online course or if you sell membership to your members, then the service providers such as Kajabi or Searchy, those service providers is your AP as well. And also sometimes your contractors, if you are providing services to your customer, like for example, if you are providing interior design service or website design service to your customers, then you may engage external contractors or freelancers, we call it, and you ask them to do the job for you, and then you will pay the money to them while you will bill your customer for the job done. So these contractors or freelancers will also become your AP as well. So does this sound familiar, AP? This is the opposite of accounts receivables. So this is something that you are waiting to pay from your business. So remember, if you are waiting to pay, this is more related to your supplier. If you're waiting to receive money, then it's more related to your customers. All right. The next one, oh yeah, another thing is just the same as AR. If you are waiting to pay for something that is not related to your trade, then those are not considered as AP. Those will be considered as the other business transactions inside your bookkeeping. So for example, if you are repaying a loan to your bank, like initially the bank borrow you money and then now you are paying back the money to the bank, then this money that you pay out will not be considered as AP. And if you are repaying, like for example, an investment into your business maybe by your friend or maybe by the other shareholders, and they would like to withdraw from the business, they would like to withdraw their investment from the business, then the money that you pay to them will not be considered as AP. All right. So only those related to trade, related to your business or services that you provide to your customer will be considered as AP and AR. Okay. Now let's move on to the next accounting jargon, JV. So what is JV? JV is also, JV is actually stands for journal, J for journal, V for voucher. So journal voucher or manual journal or simply known as journal. So, oops, I think we have a typo here. But anyway, okay, let's just correct this. All right. So JV is also considered as a journal, journal voucher, or manual journal. So for JV, it's just how to say, every transaction in your book is a double entry, whether you sell to your customer or you purchase from your supplier. So, but what if it does not belong to these two categories? It's not related to AR and it's not related to AP, not your customer or not your supplier. So the rest of the transactions, the rest of the bookkeeping transactions, we simply call it as journal or also known as a journal voucher. So a journal is an accounting transaction that you manually record into your accounting system where you have full control of the accounts to debit and credit any amount of the transaction. So for example, there are a few system control accounts which are not allowed to be used in a journal, such as accounts receivable, accounts payable, bank accounts, and inventories accounts. So these specific accounts are usually logged by your accounting system, either even if you use Zero Accounting or QuickBooks Online or any other accounting software or accounting system, they usually will log to edit or manually enter something, a new transaction by the use of a journal. So these are the ones that, apart from these specific system control accounts, you will be using a journal to record it. So for example, you can, there's usually a designated page inside of your accounting system where you'll be able to record the journal manually, and it usually looks like a table. So you'll be able to record uh, your payroll journal, for example, and some journals that's like your payroll where you will need to enter the salary amount and what's the EPF amount, what's the SOXO amount, what's the salary payable amount, or the tax payable amount. So all that you need to split out for a few transactions, a few lines, then you'll be able to use journal to record it. Okay. So for journal, usually there are designated pages for the system control accounts. So if the system is controlling on the ARAP bank account and inventory accounts, so usually if you want to record transactions to those, you can go to the respected pages, such as a customer sales invoice page or maybe your customer receipts page in order to record those transactions. So whenever you record there, the designated pages, it will automatically flow into other systems such as the AR system, where Zero Accounting will automatically helps you to compile and calculate the necessary to generate the report for you, such as the customer report and all those things. So that's why those designate those system control account, you can't really manually use a journal to record it, but instead you need to use the designated pages for it. So you may need to prepare a journal voucher if it is a requirement from your local government. A journal voucher is actually just a physical piece of paper which contains all the information of the journal along with signatures of approval and the person who records the journal in your accounting. Okay, next one. The next accounting jargon is PV. So what is PV? PV stands for payment voucher, which sometimes we will use some shortcut or shortened words, which is called PYMT voucher. So PV is payment voucher, just remember that it is actually a physical piece of paper or a digital version nowadays. It could be a digital version. So as long as it's just a simple piece of paper which contains all the information of your payments, along with signatures of approval, the person who records the payment in your accounting system, and the person who receives the money if it is a cash payment. So PV is usually kind of like a supporting document or a proof of the transaction that you have recorded into your accounting system. And if there's money involved, if somebody is receiving the cash with a petty cash voucher or a payment voucher for cash transaction, then the person who receives the money will need to sign on the paper to acknowledge that they have received the money from you. So PV is just a very simple piece of paper showing who is the person that you are paying for, what is the amount that you are paying for, what are the details of the payment, such as the invoice number and also the dates of the payment as well. Oh yeah, and don't forget the if you are paying through if you are paying from your bank account, and if you have more than one bank account for your business, like for example bank account 1 or bank account 2, and then you'll be able to write on your PV as well which bank that you are paying from. All right, the next one, closing. The next accounting jargon is closing. So what is closing? Closing, which sometimes we also refer to as a monthly closing, quarterly closing, or annual closing. So closing may be referred to we usually will attach the month or the period of the closing that we are doing right now. For example, if we are closing for the month, we will call it monthly closing. Like for example, if you are closing for the month of January, then we will call it as a monthly closing for January. And if you are doing a quarterly closing, then it will be a Q1, Q2, Q3, or Q4 closing. And annual closing. Annual closing, usually we will just call it according to the financial year. So like for example, if you are closing for the financial year of 2023, we will call it as a 2023 closing or closing for financial year 2023. So if someone says he or she is doing monthly closing, it just means that he or she is doing all the bookkeeping tasks to complete the accounts for the month. So understand? Get what it means? Closing means to complete everything and to wrap things up nicely and to close it, to put a bow on it and close it. So can you guess what quarterly closing means? Yeah, quarterly closing means to wrap up and to do all the bookkeeping tasks for the quarter and then to close it and generate the reports for your quarterly reports. Yeah. So accounting jargons is pretty easy, right? So far so good. If you have any questions, if you like this video, click on the like button. And if you have any questions about today's topic, or if you have any questions on bookkeeping or any topic request, just post it in the comments below. Okay, the next accounting jargon is depreciation. So what is depreciation? Depreciation is also known as fixed assets depreciation. Depreciation, usually we use this term depreciation for our fixed assets. So what is fixed assets? Fixed assets are um, the items, tools, or equipments, or furniture and fittings, or computer, or any kind of things that your business purchase for the use of your business on a continuous and which is more than one term. Like for example, if you purchase a computer, a laptop, the laptop you can use for more than 1 year, right? And you can use it for like maybe 3, 4, or 5 years. So these are all considered as a fixed asset, or maybe a table or a book rack. So all these will be considered as your fixed assets. So when we record the fixed assets into our accounting system, when we first purchase it, we do not directly record the full expense into your profit and loss report. We do not recognize the full amount of the cost of the purchasing of the asset as an expense as an expense for your business for the financial year itself. We are going to spread this out, this cost, spread it out into a few years. Like for example, if your laptop you can use for 5 years and you purchase your laptop for $2,000, so this $2,000 split will be divided equally, or it actually depends. It may not be equally. It depends on the fixed asset formula that you are following, which I usually use the straight line method, which will divide equally. So 2,000 divided by 5, and then every year is this particular amount of depreciation. So this kind of amount that we split it out across a few years, we will call it as the depreciation amount of your fixed asset, and which is also in general every month or every month and every year you will need to ensure that you have recorded your depreciation into your accounts. Yeah. Okay. The next one. Okay, the next accounting jargon is accrual. So, what is accrual? Accrual is also known as accrued expenses. Accrual is recording an expense that has incurred, but you have not received the bill yet. Accrual is also used to record payroll expenses that will be paid to your employees on a later date. So, for example, accrual usually happens for we usually use accrual for payroll expenses. So that means if you are if your employee is working for you in the month of January, and the payroll and the salary payment will only happen like probably in the early February, like for example 1st of February, let's say. So whatever expense or whatever salary that you are supposed to pay to the employee for the month or for the service of January. So, for example, is the salary is $1,000, and $1,000 is supposed to pay out for the month of January, but then you pay them in February instead. So we need to record the salary of $1,000 into January itself, so that this salary will be taken in as an expense in the month of January itself, and not wait until February to do it. So that's why we will have this accrual where we will accrue the expense first, and then when you pay it out later, then it will be considered to reverse from accrual rather than record it as an expense. Okay. So we also use accrual for other purposes as well. Like sometimes you may have an event, or you may have an event that happens in January, but then the supplier only bills you or send you the invoices the next month, or sometimes even a few months later, where there will be a delay in between the time of the actual event that happens and also the time that you receive and record the supplier's bill. So during this kind of situation, as long as you already know how much is the amount of the events or the expenses that you are using in the month itself, for the month of January, then you can record the amount into your accounts as an accrual already. So later on, when the actual bill happens and place where you record into your accounting system, you just reverse it from the accrual, so that your profit and loss report will reflect the correct expenses in the correct month itself. All right. The next accounting jargon is P&L. So what is P&L? P&L is also known as P&L report, profit and loss report, income statement, or the latest new name of it is statement of comprehensive income. So P&L is a very special report that I think most business owners will look at it, no matter which um, even if you do not look at other reports, P&L is the most important report that almost every business owners will look at it. So I guess you have heard this. I guess you have heard other business owners or your accountant mention P&L all the time. The famous P&L is actually an abbreviation of profit and loss report. That is why P&L. This report is also known as income statement or statement of comprehensive income. P&L is my favorite report, favorite financial report among the business owners. P&L report is the favorite financial report among business owners, and it is my favorite report too, because this P&L report, we will be able to see how much our business is performing, like how much is the profit. Everybody is anxious to know how much is the profit of the business for the last financial year, or maybe you just want to know how much is the tax that you need to pay, because the higher your profit, the higher tax you are going to pay, right? So P&L is the best report that you must know, even if you do not know any other report. So from the P&L report itself, you can see the list of all the sales, how much is the sales, and what are the sales accounts. If you did split out your sales into different products or different lines, then you'll be able to see which one is performing better. And also you'll be able to see what is the cost of your sales. Like for example, how much did you pay for your freelancers, and what are the sales amount? What's the sales amount that you collect from your customer, and how much is the cost that you have paid for your freelancers, and what is the gross profit after you deduct the sales minus the cost to your contractors, and what is the gross profit that you earn from this particular transaction. So P&L has a lot of things that you can see from there, from looking at your sales amount, or looking at your costs and how to manage your costs as well, or your operating expenses, like how to lower down your operating expenses and everything you can see from your P&L report. So this is definitely one of the reports that you must save into your favorite list. All right, the next one. The next accounting jargon is GL. So what is GL? GL stands for General Ledger, which is G for General, L for Ledger, and General Ledger, and sometimes we just simply call it as Ledger. So General Ledger is actually a report that contains all your accounting transactions grouped by the account name. So you have account name 1, for example, account name petty cash. Then all the transactions for your petty cash will appear underneath this grouping. And then once you have the total for petty cash, then the next one will be your next account, let's say a sales account. So sales account, and then all the transactions for your sales, and then the total amount for your sales account for that particular report that you have generated. So general ledger, in general, if your auditor asks for it or your accountant asks for it, when they ask you for your GL, usually what they means is they want to get all the transactions for a particular period. Like for example, if you are currently going through an audit for last financial year, then they are requesting for the GL or the full transaction list for the period of your whole financial year. Like for example, 1st of January 2024 until 31st of December 2024. And this is your financial year, and they ask you for the GL. That means they are asking you from January until December onwards, everything that you have recorded inside of your transaction, inside of your accounting system, such as your Xero or your QuickBooks Online. So if you, GL is also used, we also use GL when we want to look at why we have such a high amount of transaction inside of this particular expense. So like for example, if you look at your profit and loss report and you notice your subscription expenses is pretty high this month, suddenly every month is just $100, and then suddenly it jumps up into $1,000 last month. And then the following month, it goes back to $100. So if you would like to see and investigate and identify what happens and why this particular pattern appears, then you can generate a GL, your GL, which is your general ledger, and sometimes a certain accounting system you can filter only to see that particular account name, so that you can skip through all the rest and you only see this particular account. So you can see this account and you'll be able to see, oh, I noticed that I have recorded this annual subscription to this new service such as Canva for one whole year, and that's why this particular month we jump up very high. Yeah. Right. The next one, receivables ledger. So the next accounting jargon is receivables ledger. So what is receivables ledger? Receivables ledger is a report that contains all your accounting transactions in accounts receivable grouped by the customer name. So from this report, you will find all the invoices, credit notes, and receipts for each of your customer. So receivables ledger is more towards related to your AR. If you notice your AR report or your customer aging report is pretty high, or you would like to see all the transactions that happens within last month for your receivables, for your AR, then you can generate the receivables ledger for it. All right, the next accounting jargon is payables ledger. So what is payables ledger? Well, as you know by now, it's just like the opposite of receivables ledger. Receivables ledger is all about your AR. So payables ledger is all about your AP, which is your suppliers. So payables ledger is a report that contains all your accounting transactions in accounts payable, grouped by the supplier name. From this report, you will find all the supplier bills, credit notes, and payments for each of your supplier. So here's a bonus tip for you. And if you have been doing bookkeeping once a year, then let me introduce you to the power of bookkeeping. When you do bookkeeping regularly, you and your business will enjoy a lot of benefits from it. So let's discover why bookkeeping is the key to the success of your business. If you click or tap on the screen, you can watch that video. If you want to watch more videos on bookkeeping and accounting tutorials, subscribe to our channel. I'll see you in the next video. Bye!